What if I told you that one of the most common ways we investors judge a company is, well, it's kind of flawed. So many people get obsessed with just one number, the dividend yield. But today, we're going to uncover this hidden return that gives you a much, much better picture.
Just take a real-world example. You look at a giant, right, like Apple, and you see its dividend yield is only about 0.5%. It's so easy to think, that's it? They must be pretty stingy with their cash. But you know what? That assumption could be a huge mistake.
Because the reality is, by focusing only on that little dividend number, you could be completely missing an extra 3% return. So where does that come from? Well, that hidden value has a name, and we're about to break down exactly what it is.
Okay, so here's our game plan. First, we'll talk about the dividend trap itself. Then, we're going to make it all super clear with a simple pizza shop analogy. After that, we'll jump into the numbers, and I'll show you how to calculate the real yield. And this is important. We'll also look at when this whole thing can go wrong before we wrap it all up with the final takeaway.
All right, part one, the dividend yield trap. Look, it's such an easy mistake to make. You see a number, that dividend yield, and you just assume it's the final word on how much a company is giving back to you, the shareholder.
But here's the thing. That's only half the story. It really is. There's this other, and honestly, often more powerful way that companies can reward their owners. And if you're not paying attention to it, you're just not seeing how generous they're actually being.
So let's get into part two and see how this actually works. We're going to use the fantastic pizza shop analogy to make this whole concept totally click.
Okay, picture this. There's a really successful pizza shop, and it's a public company. The entire business is represented by one big pizza, and it's cut into 4 equal slices. You're one of the 4 owners, so one of those slices is all yours.
Simple enough, right? You've got 1 out of the 4 slices, so you own exactly 25% of the business and all its delicious profits.
Now, let's say the shop makes some extra cash. Management has 2 main choices. Option A is the one we all know, the dividend. They just hand you some cash, it's great, but you got to pay taxes on it right away. But option B, that's different. That's a share buyback. The company uses its profits to buy back a slice from another owner who wants to sell.
And here is where the magic happens. After that buyback, there are only 3 slices of pizza left. You still have your 1 slice, but, and this is the key, your ownership of the entire pizza just shot up from 25% to over 33%. You literally own more of the company without spending a single penny.
And that right there is the whole idea of a share buyback. You can almost think of it as a hidden dividend. You don't get cash in your pocket today, but your piece of the pie gets bigger, which increases your equity. And you don't have to pay taxes on it right away.
Okay, on to part 3. Let's see how we can build this into one single, really powerful number. It's time to put these 2 ideas, dividends and buybacks, together and actually calculate the total shareholder yield.
And the formula, believe it or not, is pretty simple. You just take the total cash they paid in dividends, and you add the total cash they spent on share buybacks over the year. Then you just divide that whole thing by the company's market cap, which is basically just the total value of all its shares.
Let's run through a quick example. Let's make up a company. We'll call it Amu Tech. Imagine its market cap is $100 million. Last year, it paid out $2 million in dividends, and it also spent $3 million buying back its own stock.
So, what does this all mean? Well, if you only looked at the dividend, you'd see a 2% yield, which, is not bad. But when you factor in those buybacks, the total shareholder yield is actually 5%. That extra 3% is that powerful return that so many investors just completely miss. Now, this all might sound like buybacks are a guaranteed win, but it's not that simple. Let's get into section 4, because this is absolutely critical. You have to know when buybacks can actually destroy value for you. So we have to ask the critical question, is this tool always used wisely by companies? And the answer, unfortunately, is a big, fat no. Management has to be really smart about when and how they buy back their own stock.
I love this way of thinking about it. It's like using $10 to buy a $5 pizza. If a company's stock is way overvalued and the bosses use shareholder cash to buy it at that crazy high price, they are literally just throwing your money away. It's a terrible use of capital.
So here are the 2 giant red flags you have got to watch for. First, overvaluation. Is the company paying way too much for its own shares? And second, debt.
Is the company borrowing a bunch of money just to make these buybacks happen? Because that can create this illusion of success that just isn't real or sustainable.
Okay, let's bring this all home with our final takeaway. This is really about understanding the core difference between these two ways a company can reward you, its owner.
And it really boils down to this. A dividend is cash in your pocket, right now, today. A share buyback is an investment in tomorrow. It gives you a larger claim on all of the company's future profits and its future growth.
So the bottom line is this: don't get caught in that dividend trap. To truly understand how a company is rewarding its owners, you have to look at both pieces of the puzzle, the dividend and the buyback. It's the only way you're going to see the true total shareholder yield.
So, I'll just leave you with this question. The next time you're analyzing a company, are you just seeing one little piece of the puzzle, or are you seeing the full picture? Now you have the tools to find out. Thanks for listening.